Good morning and welcome, ladies and gentlemen. I'm delighted to be here again this year. My name is Guy Anderson and I look after the Mercantile Investment Trust, which, as mentioned, is one of the oldest investment trusts listed in the UK market, with a history going back nearly 140 years now. So the Mercantile Investment Trust is looking to deliver long-term capital growth by investing in a diversified portfolio of UK-listed mid and small caps. So what I thought I'd do today is spend a little bit of time talking about why we think UK mid and small caps are an interesting part of the market in which to invest. And then I'll spend a little bit of time talking about the Mercantile Strategy itself, giving a little bit more color on what it is we look for in companies and how we run the vehicle. And then I will finish off with a few minutes talking about the outlook as we see it today and how the portfolio is positioned for the years ahead of us. So to dive straight in terms of the case for UK mid and small caps, whilst the perception is very much that the UK is a very old economy market which has delivered relatively turgid returns over the last years, I think this is a somewhat arbitrary sweeping statement, and the reality doesn't quite stack up with the narrative. And what we have shown on this chart here is the long-term performance of a number of different markets across the globe, including in yellow the FTSE 250, so that's the core mid-cap part of the UK market. And this history goes back 25 years, and we can see that actually the FTSE 250, the UK part of the market, has been one of the best returning asset classes over that time period. And indeed, if we compare it with the FTSE 100, so the large cap index, which is shown by the dark blue line, we can see quite a material difference between those. So to put these numbers in context, because of course with the power of compounding over such an extended time period, the magnitude of the numbers does become somewhat distorted. But the FTSE 250 has returned 9.5% per annum over 25 years versus around 6% for the FTSE 100. So quite a clear difference. And then of course, by investing in an active vehicle, there is the potential to earn returns above those of the broader index. So the question for me is, what is the driver of that outperformance? Is it just due to perhaps a cyclical factor, or is there something more structural underneath that leads to smaller companies to tend to outperform larger companies over the long term? Because looking at the chart, it clearly does not happen every year. And for me, it is absolutely structural. The biggest single driver is the fact that smaller companies have the potential to grow at a higher rate than larger companies, which I think intuitively makes sense. Because if you think about it, as a company becomes bigger and bigger, its ultimate growth is more likely to be limited by the underlying growth of the end markets in which it operates. Whereas if a company is relatively small, they have the potential to, for example, be nimble and adapt to change, to innovate or disrupt existing markets, or simply to operate in rapidly growing markets. So I'll give one or two examples of those, which you can see in front of you. And the first, deliberately slightly controversial, because I don't think anyone would perceive an old high street retailer to be the most nimble of businesses, but that is exactly the point. WH Smith is perceived to be a high street retailer, but the reality is, and which I think probably is not fully appreciated by the market, this year, WH Smith's will generate more profits from its North American business than from its entire UK high street business. And this is because the business has evolved quite rapidly over the last 25 years to move away from the high street into travel retail. And travel retail has far superior economics and a far superior growth profile. So that has really shifted the business, which has been facilitated by being nimble. In terms of innovative or disruptive businesses, I think a great example is a company called Big Technologies, which is a relatively new entrant to the UK market, but was a company that was founded as Buddy back in 2005, initially as a location tracking business. The genesis of this company was actually the desire to be able to track children by giving them a small location device. but it very quickly moved into being used in adult social care and healthcare, and then that morphed into applications in the criminal justice system, where they're able to apply secure tags in order to know the whereabouts of individuals. And that has huge benefits, both from a financial perspective, due to the lower costs associated with not incarcerating individuals, but also societal benefits because of the far lower levels of recidivism that one sees in the end users of those monitoring devices. And so this is a business that has grown from a very small origin to really expand into a potentially huge market, and it now has quite substantial contracts across the Americas and even as far afield as New Zealand. So a huge growth opportunity there. And then finally, what we call rapidly growing end markets or new markets. So an example of this is a company called Ergomed. They are a specialist provider of services to the pharmaceutical industry. So they will help pharmaceutical companies with clinical drug development, including running outsourced trials on their behalf, predominantly in oncology and orphan diseases. But this is quite a very specialist niche, but one that is experiencing quite significant growth. And they also do pharmacovigilance services. So once the drugs have been developed, they then need to be correctly monitored and provide all the documentation, etc., to enable them to be commercialized. And that will include things as simple as providing the medical pamphlets within medicines, as well as full monitoring of side effects, etc., etc. So that's another example, I think, of a rapidly growing business. So whilst there's a lot of talk about the UK and the outlook for the UK, I think it's really important to focus on beneath the surface and see where those actually really exciting growth opportunities lie, and which can enable some really quite spectacular returns over the long term. So with that quick introduction, I'll now spend a few minutes talking about the Mercantile Strategy itself, how we run the vehicle, and what it is we're looking to achieve. So first of all, in terms of an introduction, as mentioned, we're looking to deliver long-term capital growth by investing in a diversified portfolio of UK-listed mid and small cap. So by diversified, the portfolio has around 70 holdings. So we're not taking huge concentrated bets on any one specific investment. We are looking to make a number of investments across a wide range of sectors. Those companies are chosen for inclusion in the portfolio based on what I think is a fairly rigorous and disciplined investment process, which I'll go into in a little bit more detail. But crucially, it's based upon fundamental analysis, which is facilitated by the fact that I'm lucky enough to look after the mid and small cap team, the UK mid and small cap team at JP Morgan. So we have 6 individuals who are focused very much on researching this part of the market. And that includes a heavy amount of interaction with management teams. So as a team, we meet around 350. We do around 350 management meetings per year. So it is a fairly intensive research process. In terms of some of the portfolio characteristics, it's a good-sized portfolio, so it's a little bit north of £2 billion, which I think is important for the end investors because of the underlying liquidity that the Mercantile shares themselves provide to end investors. So in a way, it is providing very liquid access to what can be a less liquid part of the market. And then, of course, with that scale comes relatively low ongoing charges of 0.45% per annum. Now, of course, what really matters is the returns that are generated. And we can see on the right-hand side the returns over 1, 3, 5, and 10. Probably don't need me to point out that the last couple of years have been pretty hard going in this part of the market. And so I will spend a little bit more time talking about that in a moment. But stepping back from the last 12 or 18 months, well, 12 months really, if we look at the longer term performance, and here I would really emphasize that this is not an investment that should be made on a 6-month time horizon. This is a long duration investment vehicle where we're making investments in stocks that we're expecting to hold for the next 3, 4, 5 years, and which we're expecting to bear fruit over that time period. But when we step back and look at the returns over an extended time period, and here we show the returns since I came on board a little bit over 10 years ago, you can see the cumulative effect of that. So we've returned just around 10% per annum over that time period. Now, whilst long-term capital growth is the primary focus of our investment process, the board of the investment trust have an additional goal, which is to grow the dividend paid out to shareholders at least in line with inflation. And what we can see here is the dividend track record represented by the yellow bars over the last 30 plus years. And I would point out a couple of things. First of all, the dividend has in fact grown at about an 8% annual growth rate over that time period, so well in excess of inflation over that period. But crucially, and I think it's pretty obvious from the chart, the dividend has never been cut. So as end investors, I think you could take great comfort in the fact that that dividend, while nothing in life is guaranteed, that dividend track record and trajectory looks set pretty fair, with the shares yielding around, I think it's around 3.6% today. So what is it that we actually do in the investment process? So as I mentioned, I believe that it's really important to have a clear and disciplined investment process where we're holding stocks in the portfolio for a very specific set of reasons. And if those reasons are either proved invalid because the investment thesis was wrong, or something changes that will invalidate that investment thesis, that capital should be recycled and invested in something where we see better prospects. And so that is the overriding theme. It's about discipline. But what is it that we're looking for? We're looking for really a combination of 3 characteristics. First and foremost, I'd say we're looking to invest in what we think of as structurally strong businesses. So those are companies that are going to deliver strong economics and where we think they operate in attractive end markets that will continue to grow and provide that opportunity for long-term growth. That really ties into the second point about the outlook. Is the outlook improving? And here, again, I'm not talking about the next 3 months or the next 6 months. I'm talking about what a company can deliver over the next 3, 4, 5 years. And then third and finally, of course, it's important to think about the price that we're paying for that company or that security. And we look at a range of different metrics. I wouldn't like to hang my hat on any single one, but ultimately it's about the amount of cash that a business generates over time and how they can reinvest that cash to drive future growth. So maybe to bring that, before I jump into an example, it's interesting to hear, potentially interesting, what we say we do. It's more important to look at what we actually do than what we say we do. But I think looking at some high-level portfolio statistics demonstrates that we do actually do what we say we do. So here, in terms of the quality of the companies that we're invested in, we look at the return on invested capital. So effectively, what returns are the businesses generating for every pound that they invest? And we can see that the return for the portfolio is around 16%, which is well in excess of the 10 or 11% for the broader market. What is the outlook? Is the outlook improving or is it deteriorating? And here, this is an imperfect measure, but we show the change in market's expectations over the last 3 months for our portfolio versus the broader benchmark. And this is a really important statistic. You can see that our portfolio has had improving market expectations over the last quarter versus the broader market having deteriorating expectations. And then, of course, is it attractively valued? And here we're looking at the free cash flow yield. So how much cash does the portfolio actually produce versus the current valuation? And you can see quite a clear disconnect of around 7% for the portfolio versus closer to 5% for the benchmark. So I think it's fair to say that we do invest in high quality businesses with a good outlook that are attractively valued. But maybe to bring that to life, because that is quite dry, I'll run through a couple of examples, which are 2 of the larger positions in the portfolio. The first is a company called Softcat, which we've held since late 2015 when the company first came to market. So it's been in the portfolio for a reasonably long time, around 7 years. That's not atypical. I think about 30% of the portfolio has been in the portfolio for at least 7 years, around 50% for at least 5 years. So when I say we're making long-term investments, that's helpfully backed up by the evidence. But what this company does is they're an IT reseller. So they act as the sales channel on behalf of the IT vendors, and they predominantly focus on UK mid-cap companies, mid and smaller size corporates, which typically, a Microsoft will not want to sell directly to an SME that's got 50 employees. So that's when they use the sales channel. The key factor behind this business, or the special sauce of this business, is it's a people-driven business. So when we meet the company, we talk about their people constantly. Are they happy? Are they well incentivized? How are they doing, etc.? Because they are driving the success of this business by being incredibly incentivized and having their pay very closely aligned with their sales. And that has resulted in 70 consecutive quarters of year-on-year organic revenue growth, which is pretty much an unsurpassed record. I mean, it's very difficult to find a company that has such a level of achievement. And of course, our view of the outlook is just as rosy as our view of the record that they have achieved thus far. And so we've been continually happy to keep this company in the portfolio. They have a very small market share still. Their market share is probably less than 4%. There's clear opportunity for this business to continue to go from strength to strength. Another example, which actually purely coincidentally came into the portfolio at a very similar time to Softcat, is a company called Telecom Plus. Now, Telecom Plus operates a multi-utility service proposition under the brand name of Utility Warehouse. And they have a number of structural competitive advantages against the wider utility market. First and foremost, they sell a number of different utilities across the same cost base. So by a number of different utilities, you can buy your gas, your electricity, your broadband, your telephony, your insurance, etc. So they leverage a single cost base for multiple revenue streams, but the customer proposition is very different. This is an everyday low price type proposition. They are not looking to be the cheapest provider of every single service at every single point in time, but it is good value for consumers, and it has a very interesting distribution model, which is effectively a word-of-mouth distribution model. Now, this is a company that has around 800,000 customers today, so they have a very small market share in the UK with clear potential. There's no reason, for instance, for them to continue to grow. They could hit 2 million customers. That would be a 6% market share in the UK, leaving them plenty of headroom for further growth. But the important thing about this investment was we made the investment back in 2015 because we liked the strong economics and the growth profile that the company offered. But the real moment of change, and the really important thing with our investment process being to recognize change, didn't come, we had to be pretty patient, didn't come until late 2021. So after we'd held this company for nearly 6 years in the portfolio. And looking back to late 21, I'm sure many people will remember quite significant changes in the energy distribution markets in the UK. A number of operators started to go out of business, and the market really consolidated around the structurally strong providers, of which Telecom Plus is clearly one. So the growth opportunity really exploded at that point, and they have delivered quite substantial growth since that time. So hopefully that gives a little bit more insight into actually what sort of companies we're looking for in the portfolio, because it is very much a portfolio that is built up based on bottom-up stock selection. So it is not about the top-down view, it's about the individual stocks and the opportunities that they present. Although, of course, one cannot do that in a vacuum without considering the outlook. And so with that in mind, I will now talk a little bit about the world in which we're operating. And whilst it is not directly relevant, perhaps, for all of our companies, I think it would be remiss of me if I were not to mention some of the activity that we're seeing in North America at the moment, where, of course, I'm sure everyone will have seen some of the issues in the US regional banks. Now this chart shows, the lines effectively show whether US credit markets are tightening or loosening. So what this means is, are lenders based in the US providing more credit on easier terms, or are they providing less credit and providing it on harder terms to borrowers? And that's incredibly important because credit is ultimately the lubricant that facilitates global economic growth. And what we can see, and what this chart shows, is that in periods where credit is generally tightening, we are more likely, or North America is more likely to enter a recession. So there is a very clear link between tighter credit and slowing economic growth. And unsurprisingly, given what's happened to some of the banks over in North America, we are currently in a period of tightening credit conditions. So whilst I don't personally stay up all night worrying about a repeat of the GFC, my base case is clearly not that we're going into a full-scale credit crisis of any sort, but I think we have to accept that credit is going to be tighter in the future than it has done in the past, certainly at the moment. So that will have a bit of a dampening effect on broader global economic growth. So I thought it was important just to touch upon that, because we cannot ignore that risk. However, bringing things a little bit back closer to home, the picture is, again, not rosy, but it is not as bad as I think many people think. So when we invest in the UK, it's very important to differentiate between the large caps and the mid caps. Large caps, so the FTSE 100, which are listed in the UK, are generally not representative of what most people would think of as UK PLC. If you think of Diageo, Shell, BP, Ashtead, any one of these companies, the majority of their revenues and profits are actually sourced overseas in international markets. Whereas if you look in the smaller companies, they tend to be far more domestically focused. And indeed, mid-caps and small caps tend to generate around half of their revenues, so half of their profits, from within the UK itself. So it is important to think about the UK economic outlook. And as we show on the left-hand side of the chart here, and as everyone is acutely familiar, headline inflation has been a major headwind, in particular over the last 12 to 15 months, where we've come out of the pandemic, we've emerged from the pandemic, reignited the global economy. That has caused, of course, a huge number of supply chain challenges, because you cannot just turn off and then turn on again. Very, very complicated supply chains. And then, of course, that was heavily compounded, as we all know, by the Russian invasion of Ukraine last year, which has had a massive impact on energy markets in particular. And so we've seen this huge surge in inflation, which is very detrimental to economic growth more broadly. The impact of that can be seen quite clearly on the right-hand side, where we can see UK consumer confidence falling actually in September of 2022, so September of last year, to the lowest level on record since consumer confidence started to be measured in 1974. So lower than at any of the previous recessions in the last 50 years. So clearly, sentiment incredibly negative. And we can also, that clearly creates uncertainty for the economic outlook. Due to that inflationary environment, the Bank of England has obviously gone on a course of quite aggressive monetary tightening. We can see that feeding through in mortgage rates, which you can see on the left-hand side of the chart. So a year ago, mortgage rates between 1% and 2%. In September or October of last year, they reached 6%. So that is clearly quite a major tightening in credit. But again, I'm going to linger on that. September and October of last year was when that happened. What you can actually see is since then, credit has started to loosen again. And on the right-hand side, perhaps the saving grace for the UK is the strength of the labour market. And we can see that unemployment is down pretty close at historic lows, and that is resulting in wage inflation coming through, which is hugely important, bearing in mind those inflationary factors that we talked about. And so actually, whilst a lot of these charts are negative, and we can see again, I'll just headline, inflation peaking last year, consumer confidence troughing last year, mortgage rates peaking last year. The important point is the peak negativity came in the third and fourth quarter of last year. That was a period where, if we all look back fondly, there was a lot of uncertainty about the political outlook in the UK, some of the decisions that were being made, and the Bank of England having to step in. What we've seen since then, because of the strength of the labour market, is actually consumption has been more resilient and things have somewhat stabilised. Clearly, we're in an uncertain environment, but things have improved potentially from what was a very uncertain base. Looking more internationally for a moment, I'll make this one quite brief. We show here, and this is important because much of our international exposure in the portfolio is in industrial-facing companies, so we think quite heavily about the industrial cycle. We show on the left-hand side manufacturing PMIs, which are a good lead indicator for industrial production. And generally, one can see this has been, again, on a declining trajectory since that sort of re-emergence from the pandemic, where there was this huge soaring demand. That demand has come back. But if you squint, it's gone up a little bit recently. So my key message from all of these macro slides is, yes, there are lots of risks around, but the reality is often not as bad as the narrative that is heavily peddled in the UK. And yet, UK valuations are currently trading at approximately a 40% discount to other international markets. So that is the largest discount, certainly, that we've seen in the last 40 or 50 years. The UK does tend to trade at a bit of a discount to other assets, but that discount is incredibly wide. So it means if you're looking at it today, you're buying some of those high-quality businesses on the cheapest valuation that has been available for quite some time. And this is the point where I'll reference back to a statistic that I shared before, which is the underlying performance of the portfolio has been quite resilient. So that point that I made about where expectations are moving, is the portfolio has seen an increase in expectations, that 2.4% over the last 3 months, despite having that very low valuation point. So I think the outlook is uncertain, valuations are very low, but actually the portfolio is performing quite resiliently. And that latter point is very important, and that is the point that we focus on, and why when we build the portfolio, again, on a stock-by-stock basis, it is not concentrated in any one specific area. We're not making a huge bet on any one type of company, and you can see that quite well demonstrated looking across the top 10 holdings, which come from a range of different end markets and industries with a range of different geographic exposures. So I know I've mentioned Softcat and Telecom Plus earlier. Dunelm is a company I've talked about in the past, where crucially around 85% of their growth over the last 10 years has been driven by market share gains rather than what the end market is doing. IMI, which is an engineering company that specializes in products and services used in flow control, so things like valves, is a company that has strong economics but has really reinvigorated its commercialization aspect, so working much closer with customers to drive better growth. So there's a common thread, hopefully, across these businesses that you can hear, which is a greater focus on those companies with a strong market position, which are in more control of their destiny than simply relying on positive end markets. So to summarize very, very briefly, I think the UK mid and small cap market is a really interesting market in which to invest, and I would definitely encourage people to consider it. Mercantile itself, which has been, as mentioned, investing in this market for quite some time, has a disciplined investment process where we don't look to change based on the fads. We look to make long-term investment decisions and benefit from those. We absolutely cannot ignore inflation and the second-order effects which are impacting not to mention geopolitics, which are of course impacting economic growth, but that really emphasizes the need for us to focus on resilient businesses which are in control or more in control of their own destiny than just relying on positive end markets, and of course to buy them at a compelling and attractive valuation. So with that, I'd like to say thank you very much for your attention. I will be over by the JP Morgan stand for a little bit. If anyone has any questions, of course, I'd love to answer any questions. But that's it from me. Thank you.